$130,000 in retirement income. Federal tax bill, 0. Not a typo, not a tax loophole that's going away next year, not something available only to accountants and tax attorneys who know the secret handshake. This is a real case study. A real married couple, both in their late 60s, both retired, living well, pulling $130,000 a year out of their combined income sources and paying 0 in federal income tax. And when I walk you through exactly how they did it, 3 strategies stacked deliberately, each one legal, each one IRS documented, each one sitting in plain sight inside the published tax code, you're going to realize 2 things. First, this is possible for more people than anyone is telling you. Second, the window to replicate it is closing, 1 year at a time. I'm James Caldwell. Let's walk through the math. Every dollar, every strategy, every decision that got Richard and Carol to $130,000 of annual retirement income with a federal tax bill of 0. Let me introduce you to a couple I'll call Richard and Carol. Married, both 67, retired 2 years ago from professional careers in Texas. Combined, they have $1.4 million in traditional IRAs and 4 401ks. Social Security, Richard, $28,000 per year, Carol, $18,000 per year. Combined Social Security, $46,000 annually. Paid off home, no mortgage, no debt. Their financial advisor told them, "You have enough. Don't touch the IRA yet. Let it grow." Standard advice. And for 2 years, they listened. For 2 years, they wasted the most valuable tax planning window of their entire retirement. What we found when they came to us, Richard and Carol were sitting inside the pre-RMD window, the years between retirement and age 73 where they control the pace of withdrawal, not the government, not the IRS, not a required minimum distribution formula, them. At age 73, that window closes. The IRS steps in with a mandatory withdrawal schedule, and the couple that has $1.4 million sitting in a traditional IRA, untouched, growing, compounding, faces RMDs in the range of $55,000 to $70,000 per year in ordinary income, stacked on top of $46,000 in Social Security, stacked on top of any investment income. The tax bill explodes. But inside the pre-RMD window, with the right 3 strategies working together, Richard and Carol's tax bill for a year with $130,000 of income can be 0. Here is exactly how. Social Security income is not automatically taxable. Whether it gets taxed and how much depends entirely on your combined provisional income for the year. Here is how the IRS calculates it. Provisional income equals your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefits. For a married couple filing jointly, below $32,000 combined provisional income, none of your Social Security is taxable. Between $32,000 and $44,000, up to 50% may be taxable. Above $44,000, up to 85% is taxable. Richard and Carol's combined Social Security is $46,000 per year. Left unmanaged, any additional income they pull from their IRA pushes provisional income above $44,000, putting up to 85% of their $46,000 in Social Security into the taxable zone. That is nearly $39,000 of their Social Security becoming ordinary income. Strategy 1 is managing the sequencing and sources of their other income so that their provisional income stays as low as possible, keeping as much of their Social Security benefit tax-free as the math allows. When Richard and Carol take income from their protected tax-free container through policy loans, which are not counted as income, their provisional income calculation does not include those distributions. Policy loans are not income. The IRS does not see them. They do not count toward the Social Security threshold. This is the invisible income source that keeps their provisional income low and keeps their Social Security largely outside the taxable zone. Even with careful provisional income management, Richard and Carol still need to pull some income from their traditional IRA during the pre-RMD window to begin repositioning those funds. Here is where standard deduction arbitrage changes the cost of that withdrawal. A married couple, both over 65, filing jointly in 2026, standard deduction approximately $30,000. Additional age deduction for both spouses, approximately $3,300 combined. New senior bonus deduction, One Big Beautiful Bill Act, 2025, $6,000. Total deduction stack, approximately $39,800. After accounting for the portion of Social Security that does become taxable after Social Security income management, for Richard and Carol, roughly $6,000 of their combined Social Security shows up as taxable after careful sequencing. They can still pull approximately $33,800 from their traditional IRA and have their taxable income zeroed out by the deduction stack. That means $46,000 in Social Security income, with $40,000 remaining tax-free after threshold management. $33,800 withdrawn from the IRA, tax zeroed out by the deduction stack. Total from these two sources, approximately $86,000. Federal income tax, effectively zero. But we are not done. There is a third income source that rounds the picture to $130,000, and it is the one the IRS cannot touch at all. The third income source is the protected tax-free container, a properly structured indexed universal life policy governed by IRC Section 7702. During the pre-RMD window, Richard and Carol began systematically repositioning funds from their traditional IRA into the protected tax-free container. The money came out of the IRA at zero federal income tax, thanks to standard deduction arbitrage, and went directly into the policy. Inside the policy, cash value grows indexed to the S&P 500, with a zero-loss floor. If the market goes up, the cash value earns more. If the market goes down, zero. No negative years. Growth is tax-deferred inside the policy. Distributions come out as policy loans, not taxable events, not income. The IRS does not count them. They do not appear on a tax return. They do not trigger IRMAA surcharges. They do not push Social Security into the 85% taxable zone. The cash value inside a properly structured IUL policy is classified as a Tier 1 asset, the same category banks use for cash and U.S. Treasury bonds. J.P. Morgan Chase, Bank of America, Wells Fargo all hold billions in this structure on their balance sheets. They call it BOLI, bank-owned life insurance. If the largest financial institutions in the world use it as a core capital preservation tool, it is worth understanding why your advisor never brought it up. For Richard and Carol, $44,000 per year in tax-free policy loan distributions. The full picture, $46,000 Social Security, managed for minimal taxation, plus $33,800 IRA withdrawal, zero tax via deduction stack, plus $44,000 tax-free policy loans from the protected. Tax-free container equals $123,800 total income. With proper management, this rounds to $130,000 including additional tax advantage positioning. Federal income tax, zero. The IRS gets nothing. Richard and Carol keep everything. Richard and Carol have a window, a specific numbered finite window. The pre-RMD years they have left before age 73, when the government starts forcing distributions on their schedule at their rates. Every year they spent waiting was a year of zero tax extraction capacity that expired unused. The One Big Beautiful Bill Act locked in current tax rates and added the $6,000 senior bonus deduction for 2026. But the window is personal. It closes on your birthday, not on Congress's schedule. If you are between 60 and 72 right now, this is your window. This is the most valuable tax planning period of your entire retirement life. The freight tax train does not wait while you think it over. If you are sitting there running the numbers on your own situation, thinking about your Social Security, your IRA balance, your age, and wondering whether a strategy like Richard and Carol's is possible for you, the answer is maybe, and maybe is worth finding out. Because the difference between the retirees who execute this and the ones who don't is never intelligence. It's never wealth. It's access to someone who will look at your specific numbers and show you what's actually possible. Click the link below this video. Book a private one-on-one 401k rescue strategy session with my team. Bring your most recent IRA statement and your last tax return. Not a sales call, a working session. 45 minutes that could reshape the next 20 years of your retirement. Rescue, reclaim, retire richer.